Hi everyone, my name is Simon Mishevich from Optimised Accountants, and in this video I want to talk about buy-to-let investments and what the basics are. I'm going to talk to you about all of my clients. We've serviced probably 2,000-3,000 people talking about property investing, whether it's retained services or it's ad hoc. And they always come back and we analyse the data forensically so we know what we're talking about. We're not just talking about theory, about going on a course over a weekend and you also know everything. What I want to talk to you through is the things that I see my clients, what they go through, some things that they do, some things that they don't, but holistically, these are the kind of things that we think you should be doing. So if you're looking for some online calculators for property investing, then look no further than our website. You can go to use that QR code to go to our website and get all the calculators that you should ever need. First of all, capital growth. Now you might want to hold for the long term, you might want to rent it out for the foreseeable future, but it's really the intention is, as long as it washes its face, which means break even, by the way, as long as it breaks even, then you're quite happy. You're not looking for making profits at all. And then you might wish to flip the property. So you buy it straight away, do some development on that property, and then you flip it and then move it on. Or you could be looking for income, renting the property out. Now you could be looking for supplementary income. So you're happy with your job, but actually you want more money and you can see that's coming from property. Alternatively, you may say, well, actually, I'm looking to replace my job. I don't like my work anymore, or I want a change of lifestyle. Therefore, renting property sounds more appealing to me. If that's the case, then of course, you will need to be thinking about the short term and the long term of how you finance whatever investments that you make. Why house price increased in value? Well, there's several factors for this. And by the way, you may not be just looking for capital appreciation. You may want to have rental income, but understanding capital appreciation will also help you to understand, well, where's your investment going to be going in the long term? So the first thing is supply and demand. I know some people will say, I hate that phrase, supply and demand. What does it really mean? Well, if you think about it, if you have got pizza, I know, strange analogy, but just bear with me a second. If you've got pizza and no one's hungry, and they're all vegetarians and they've got gluten intolerance, it doesn't matter how much pizza you have, no one's having this. So it's a waste of money. And therefore the value of that pizza will come down. However, if you have got a nice buffet of food that everyone already enjoys and people are starving, then you know full well you could increase your prices of whatever food that you're selling. Really strange analogies, but hopefully you understand what supply and demand really means. It's as much as more people want it, the price keeps going up. The less people that want something, the price keeps going down. And that's no different for property prices. If people are going into an area such as Leeds, for instance, if more people are going there because there's bigger businesses over there, there's universities in there, there's greater infrastructure there, they're making the nightlife even better, economically it's booming, then people will go to Leeds or any other city for that matter. But the big thing is there's now more demand, and therefore there's not going to be much more supply if the building's already there. So what will happen? Prices will increase. Second thing is economic growth. I mentioned about the businesses investing in a certain area. So you could look at an area that has maybe run down over the last few years and now been injected with money. I remember Nottingham when it became the hub for a lot of the infrastructure for Amazon and for storage, the infrastructure for the tram system, which really made it better for people to get around. There's a lot going on at that time. Now, that always brings more people into the city because you have people looking for jobs. People looking for jobs may want to relocate, and therefore property prices again will go up with the more booming of the economy. Infrastructure, talked about trams, but you could have a new train line system going through. HS2, what's that? You could have a new bus system going into place, tram systems. You may have ferries going from one port to another, one being built. We're seeing more ports being built actually in the northeast, northwest than ever before, because we know we can ship things more to across the Atlantic and to Europe. So all of that infrastructure means that people may again be happy to not be, as an example, people may think, well, I want to work in London, but it's really expensive. So I will get on a tram or a tube or a train, or the teaser, all the way getting into London. So Luton could be an example where people live because it's cheaper there. And as a result of that, Luton prices start to creep up even more. Government policies. Now, government policies may be that we want to inject money into an area. So it could be a development site for business or the hubs that we talked about earlier. So depending on what the government are doing, how much money they're pumping into an area will indeed help the economy in that area, and then in turn will then push up house prices because more and more people want to live there. Interest rates and inflation, of course, they have an impact up and down, by the way. So if interest rates are low, means that people can afford more mortgages because the interest rates are so low. Therefore, they are willing to input more money into a home. Inflation, if there's greater inflation, therefore the cost of living is higher, then they can't afford to buy a home that's more expensive than the one currently you live in. So they have to make do. But inflation comes down, interest rates goes down, then all of a sudden they can start to focus on buying a bigger home, and therefore prices of property goes back up again. Financing your investments. How do you finance an investment? Where do you even start? Well, first of all, you need a deposit if you're looking for a property at £100,000. Good luck with that. But if you are looking for a property price at £100,000, you are going to have to put in a deposit of 25% at the very minimum. Therefore, £25,000 is going to come from you. Now, a bank under a mortgage will be 75%, so you can invest using their money. That's a nice thing, isn't it? You are buying a property at £100,000 with just £25,000 of your own money. Not only that, but when the house doubles in value to £200,000, you still have only invested that £25,000. So your appreciation in value goes up because you're not paying all of that money, appreciated value, over to the bank. You're keeping it. And that is the beauty around property investing. We are not seeing that right now, property appreciation, but it is a long haul in terms of the course of your investment journey. So don't expect something overnight. Raise money against your own home. If you are looking to raise a mortgage, but you have an unencumbered home, please do think about mortgaging your own home, because the interest rates on your home may be cheaper than a buy-to-let mortgage product. Now, I'm not giving you any financial advice here, but I'm sharing what I see my clients do. And therefore, I can observe what other people are doing, raising money against their own home, paying a mortgage of 3-4%, rather than getting a buy-to-let mortgage of 7 or 8%. It makes a lot of sense. So we'll look at all of your options with a financial advisor. Taxation. What tax will you pay? Well, first of all, you might pay income tax if the property is in your own name, or if you choose to use a limited company, you'll pay corporation tax. And a lot of my clients are now using limited companies. Why is that? Well, this slide will come into this. Section 24. Section 24 means mortgage interest relief cap. It effectively means that you only get a 20% tax reducer on the mortgage interest costs, and you are not allowed to offset the mortgage interest costs fully. Couples tax focus. Why am I saying this? I'm seeing a lot of mistakes where people are focusing on just their own tax perspective. So husband and wife, one of them buys property in their own name, rents it out, and then gets all the income in their own tax return. And all of a sudden they start paying more tax than they need to. And that's because they should have shared some of that income with their spouse who's on a lower tax bracket than themselves, but they don't do it. So always focus on you as a couple or you as a family whenever you're doing tax planning.